What is this 41% max DTI on VA loans? I recently had someone reach out to me letting me know that his lender said he couldn't use a VA loan because his debt to income ratio was over 41% and the VA had a cap. But he could use a conventional loan. Now that seemed pretty odd to me, but you never know because the VA has updates to its policies all the time. So I went into the VA Handbook, which is the Bible that has everything that you need to know about a VA home loan. It's 616 pages of everything you could imagine. Now just remember, you also have to check out VA circulars because they do make updates to the handbook. So let me share with you guys what I found and what they're talking about, because definitely there needs to be some clarity around this 41% requirement that the VA has. So here you guys are going to see, this is the underwriting section in the basic elements of a VA guaranteed loan. Again, this is in the handbook on page 92. And basically it's saying that, hey, the underwriting has flexible standards, but the veteran must meet a couple things: satisfactory credit and satisfactory repayment ability, right? So it includes stable income, residual income, and then the important part, which is the acceptable ratio of total monthly debt payments to gross monthly income. A ratio in excess of 41% requires closer scrutiny and compensating factors. Now, there's definitely a big difference between looking at residual income and debt to income ratios. Now, let me explain that to how this piece works. So debt to income is your gross income divided by your monthly liabilities and also including your future payment on the mortgage. Residual income looks at it a little bit different. They look at net income after you've paid your state taxes, federal taxes, state taxes, Social Security. All of those taxes are withdrawn. Any liabilities that you have on your credit report are also going to be factored into that. And they're also going to factor in 14 cents per square foot of the property for utility costs. Now let me share my screen again. This is once again in the VA handbook, and it's going to show you what that residual requirement looks like. So it's going to be based on the family size. And one thing to note here, this is for loan amounts over $80,000, which pretty much applies across the country, where the average is just a little over $400,000. This is on page 192 of the VA handbook, if you guys want to take a look at this. So here it's going to say that if you're a family of 3 living in the Midwest, you have to have a minimum residual requirement of $889. Now below that, it's going to say where you live is basically what region you're a part of, right? So it's important to understand how this part works because it does affect your income. When we get calls from veterans that are saying they're getting denied for a VA home loan, it's typically some type of residual requirement that's happening because, again, lenders do factor in square footage in the residual calculation. Now, let's talk about how to overcome this. So let me switch over to page 186. Now, this is going to outline in greater detail what the debt to income ratio is for the VA home loan. Now, here it's stating very clearly, a ratio greater than 41% requires close scrutiny unless, and this is going to be the key because lenders should be already factoring this into their approval process. So here it's going to say the ratio is greater than 41% unless it is largely due solely to the existence of tax-free income, which should be noted in the loan. Now, what that is, tax-free income, would be like your VA disability income, right? That would count towards that. And then the other part, which is critical to understand, is residual income exceeds the guideline by at least 120%. So when we looked at those numbers a little bit earlier, any number over debt to income ratio over 41% requires the lender to gross up that residual requirement, which I'm going to show here one more time, here by 20%, so essentially 120%. So if you have a residual requirement of 738, you basically need to have a bump up to 885.60 a month, and that's what a lender should be looking at. So if they miss that, that's bad on them, not good for you. But again, that's something that you should be factoring in and educating yourself about when it comes to understanding this process. There's also another big piece to this, which is really understanding a manual underwrite versus an automated underwrite. Now, I've talked about this in videos in the past, but I want to kind of break this down again because it's going to change how a lender is going to look at residual income and based on who they're working with on their investor side, or the actual lending institution itself may have an overlay. Right? The VA is pretty loose in its requirements for what they require for a VA home loan. So a lot of times lenders are going to say, well, that's kind of too loose. We want to implement X. And a good example of that is the VA doesn't have a minimum credit score, but lenders do have an overlay for that credit score. And that's why it's so important to shop around and see who you can work with that will help you through this process. So explaining automated approval. So most mortgage companies will have some type of system that they can input your loan application and they'll be able to generate a decision from an automated system through Fannie or Freddie Mac, okay? And if it doesn't come back approved based on the information that was provided, this is why it's important to provide all your information because they need to look at your pay stubs. They need to see what deductions exist. And sometimes veterans or people in general don't update their deductions correctly. Sometimes too much money is being taken out. So then the lender will have to manually get that updated. So that is a thing that can be done, or you need to update it manually so it is showing or reflecting correctly. So then you can get qualified the way you want to. So if it's not automatically approved, then it gets basically downgraded to a manual underwrite. So a manual underwrite is where basically the VA is saying that based on your credit, your income, your DTI, whatever, or residual, it's saying that it cannot approve it automatically and that an underwriter needs to review it and then match it up against the VA guidelines manually and then make that assessment and approve it. Now, a couple things are going to change within that. VA technically doesn't have like a DTI requirement on manual underwrites, but lenders do, and they vary widely across the entire space. So let me give you a couple examples. Not only is it DTI, it's also residual income requirements can change. And this is why you could be approved with one lender and not another lender. So typically what we see in the lending space for manual underwrites is where you're going to be capped at a 50% debt to income ratio. There's flexibility. Sometimes we've seen people go higher than that, but typically 50 is kind of the max. The other part is they also increase residual requirements, not by a little, but sometimes by a lot. When I say a lot, like 200%, so that doubles the amount. Now, if you think about how it compares to a conventional loan when they're looking at debt to income ratios, residual income gives you way more flexibility to qualify for a lot more. So that's just something that you have to kind of think about when you're going through this process. Because there's going to be those factors that affect your ability to purchase. Now, the same thing applies if you have a service-connected disability. Some lenders will allow you to omit that from the calculation when purchasing a property, and again, giving you more flexibility. But just note that you do have to pay those taxes because either you're paying taxes in arrears, meaning that it might be like another year or two before the tax exemption kicks in, or you're paying taxes current. But still, a lender may require you to set up taxes and insurance, and then after you've closed, they will then be able to you've closed, you've submitted the application to the county, you got the exemption, then you provide it to the mortgage company, they update your mortgage payment, they refund you the taxes that weren't, or they saved up for, but they're no longer due. And then you get that money back and you can use that money for whatever. So hopefully you guys liked the video. Make sure you guys smash that like and subscribe button, and I'll talk to you soon.